Greetings and welcome, to everybody. I'm just so glad everybody's here for this session. You can tell it's kind of the day's winding down a little bit, so I'm glad that everybody's here to talk about what I feel is one of the more important aspects of trading, and that's identifying the trend so we can take trades in the direction of that trend. And as it says on the chart here, this is The Trend is Your Friend, Trend Trading. My name's Richard Crevo, and I'm one of the course instructors, one of the trading instructors at Daily FX. And again, glad that you're here. And you've probably seen a few risk disclaimers, over the course of these sessions. And I want you to be aware of these things, because ignore them at your own peril. Because I don't know how long you've been trading. I don't know if you've experienced losses or anything like that. But as it says right up there, trading foreign exchange on margin carries a high level of risk, may not be suitable for all investors. That's the truth. So adhere to that type of thing. I add my own little piece of information to this called risk capital, the phrase risk capital. You should only be trading with money that you can define as risk capital, and risk capital is defined as money that you can afford to lose, because you are going to have losing trades. Yeah, it happens to every trader. The very best traders, the guys that have been trading for years, and they're trading for banks, they're trading for hedge funds, they really know what they're doing, they have losing trades. And you're not going to be any different, I'm not going to be any different. So if you're trading with money that you know is earmarked for something else, it puts extra pressure on you. I mean, think about it. If you're trading with money that you've got a trading account, and in there you have a few $1,000s, and you want to grow it, and that few $1,000s that you have in there is for next month's house payment, or it's the beginning of your kid's college fund. Don't do that. Don't put that pressure on yourself, because think of the emotion on that. I actually had somebody, this was years ago, when I was in the sales component of FXCM, a gentleman called me up on the phone. I was talking with him. This actually happened. This was a Monday, and he said, I've heard about FX. He says, I've got an $1,800 house payment due on Thursday. Can I make it in this market? This was Monday. And I said, perhaps this isn't for you. Because it could happen, but it's not that type of situation. So just a word to the wise, risk capital, that's all you should be trading with. What we're going to be talking about here, trend trading, is just the objectives of the session going to be to show the importance of trading with the trend, show how to identify the trend, show how to determine the relative strength of the trend, and show how to enter trades in the direction of the trend. You see the theme, the trend, the trend, the trend. It's really important. And some of you that have been in my other sessions may have seen this particular cartoon. First time I saw that, I was almost on the floor. I just thought it was great. Here's this guy, it's like he's looking at these pictures like he's discovered the secret of life. In a bull market, it goes up, and in a bear market, it goes down. Wouldn't it be great if it were that simple? And then the more I started looking at that picture, I'm going, by golly, he's got it right. Those pictures got it right. In an uptrend, we want to buy, and in a downtrend, we want to sell. And of course, there's some hiccups in between, which I'm sure all of you have experienced if you've been trading for a while. But essentially, that's what it boils down to. Buy in uptrends, sell in downtrends. Okay, the method and the rationale behind trend trading is select the pairs that are in the strongest trends and trade them only in the direction that they are already going, not in the direction that you think they should be going. And the danger for some traders is somebody might say, well, I only trade the pound dollar, or I only trade the euro yen, or I only trade the dollar yen, something like that. And so if that's the pair that they're married to and it's not trending, they still want to trade anyway. So they trade in a tougher situation to trade when maybe the pair is not trending that much or not trending at all. It's just flat. So what I like to do, we offer 56 pairs to trade on the trading station, and I probably go through 24, 26 pairs each day, looking at the daily charts and the 4-hour charts to determine which way the pair is trading and which demonstrates the strongest trend. Out of those 26 pairs, there might some days be 1, 2 or 3, some days none that are trading or trending, and those days I'm just not going to trade. And I know that's very frustrating, because as I mentioned in some classes, we're all here because we like trading. And when you like to do something, it's frustrating when you can't do it. And I know when I first started, well, I'd probably been trading maybe a year at that point, I'd still get frustrated because I'd sit down in front of the computer and I go, okay, you know, like a job. I'm here to work, I'm here to trade. Show me the trades. And I'd look at the charts and I go, there's nothing there that qualifies. And then I'd get bored. And an example I used in the last session was all of a sudden that trade that didn't look really good about an hour ago, now that I'm bored out of my mind, you know, maybe that's not a bad trade at all. And all of a sudden I'm in a trade for an emotional reason, which is a dumb reason to enter a trade, and then I get upset because it didn't do what I wanted it to do. So that word to the wise, just because you're ready to trade doesn't mean the market's ready to give you a trade. Okay, trading with the trend. One of the examples that I always use is, let's say you're running a race. Would you rather be running a race with the wind at your back or the wind blowing in your face? I'd rather have it at my back. It's never going to hurt me with the wind at my back. Sometimes it's going to help me more when it's blowing stronger. Sometimes it's going to help me less. Sometimes it's not going to help me at all when the wind's not blowing in that direction. But it never can hurt me. It never can work against me. If I were running in a race, would I rather be running uphill or running downhill? Easy, no brainer. I'd rather be running downhill. This guy's running uphill. And while he looks like he's in pretty good shape, he's going to make progress going uphill, but there's going to be more stress on him, on his body. There's going to be more strain on his body. It's infinitely easier to run downhill. Like, the biggest thing this guy's got to worry about is going downhill so fast he doesn't fall forward. But he's going to make progress, even though he's maybe not in as good a shape as the other guy. He's going to make progress probably faster and more efficiently going in that direction because, in effect, he's running in the direction that the hill is sloping. In this case, he's not running uphill like this particular gent is. You know, another example would be, would you rather be swimming upstream or downstream? You know, and you can think of a million of them. But it works in other aspects other than trading. Just the trend. Determine the trend and trade in that direction. Okay, before we move on to how to identify the trend, any questions on the importance of the trend? Because essentially when you're trading in the direction of the trend, you're trading in the direction that the market is taking the pair. And the market is stronger than any of us. The entities that create trends are huge banks, huge hedge funds. You were right, the retail trading market is, you know, this big compared to the overall trading market that's out there. Retail traders can't move a market. You know, and maybe George Soros can, but I wouldn't, you know, consider him necessarily a retail trader. But essentially, we can't do it. So our job is to identify the trend and kind of jump on and ride along in the direction of the trend for a while, and then jump off at either the point where it starts to reverse and go in the other direction, or I'm looking for 75 pips. And then once that pair makes 75 pips, then I'm out of there. I bail on the trade. It's almost another analogy you might use is, let's say I'm in the middle of the jungle someplace, and I know the town that I want to get to is over there. And here's two elephants. One's coming from this way, going in the direction that I want to go, and the other one's coming from that way. Now there's some people who'll get on the elephant that's already going in that direction, and then there's other people who try to figure out a way to get this elephant going the opposite direction to turn around to go in that direction. That's a lot more work, and it may not work out. So I'm going to get on the elephant that's going in the direction of the trend. I'm going to trade in the direction of the trend. Now, one of the things about this chart, got an uptrend, Swiss yen daily chart, and the green lines here, hopefully you can see them. The green lines represent moves to the upside. The red lines represent moves against the trend. And you can see that the green lines are longer in duration and generally smoother. The candlestick action above the charts, or above the green lines, are generally smoother than the movements against the trend. If we were to add these up, and I've done this on certain occasions, not on this particular chart, but on a daily chart about this length of time, the uptrend moves gained about maybe 7,800 pips, and the downtrend moves gained about 4,200 pips. So the against the trend moves are nothing to sneeze at. I mean, I'll take 4,200 pips any day of the week, believe me. But those 4,200 pips that come against the trend come at a greater risk to me. There's more risk associated with trading against the trend than there is going with the trend. And we'll talk a little bit more about that. And here's the same thing in a downtrend. Dollar Swiss chart. This is like one of the perfect charts to demonstrate a downtrend. Okay. Same thing here in the downtrend. Look at the green lines, and you can just see, eyeballing them, they're longer and smoother than the moves against the trend, which are shorter. And if you could see those candlesticks a little more clearly, the choppiness that goes against the trend versus the smoothness that goes with the trend. So this, to me, this type of chart is a very compelling reason for trading with the trend. And I'm not going to take trades. You know, some people will say, well, why don't you take those counter trend moves? Well, I could, but again, there's more risk associated with it. And if I stay in the trade in the direction of the trend, I'm ultimately going to gain more pips. So why would I make it more difficult on myself? Trading's difficult enough anyway. Don't make it harder by, you know, well, now I'm going to go short. Now I'm going to go long. Now I'm going to go short. It's harder. It's harder to do it that way. So 3 checkpoints for trend trading. And we'll go into these in detail. Is price action above or below the 200 period moving average? Simple moving average. What direction does price action slope from left to right on the chart? And is price action making higher highs and higher lows, or is it making lower highs and lower lows? Okay, simple moving average, 200 period simple moving average. For those of you that might not know what that indicator is showing you, any place along this line that I put my little red dot here, if I can hold it steady, let's say if I just put it right there, that price that red dot represents along that 200 simple period moving average right there is the average of the previous 200 periods closing price, all added up, divided by 200. This is a daily chart, so a 200 period moving average, the period on this chart is a day, we're looking at the average of 200 days. So the way that number would be arrived at is if I would go back and add up the closing prices of those 200 candles to the left of my erstwhile pointer here, that would be, we'd add all that up, divide it by 200, the closing prices, that's what that 200 period moving average is. Now when price action is trading below the 200 period moving average, if this is the average and we're trading below it, that's indicating that the pair is increasingly moving to the downside. It's keeping its distance below the 200 period moving average, and in fact, it's pulling away from it. It's moving farther away, which indicates that momentum to the downside is increasing. First checkpoint. Where is price action relative to the 200 period moving average? Next, connecting the last candle on the left. I mean, this seems very simple, and this is you know, really what helped me out in the beginning too, is connecting that last candle on the left with the last candle on the right. That's our second checkpoint. And see the slope that's created by price action. Now my associate, Matt Russell, he's got a statement I think that is just great, where he says, if you can't step to the other side of the room and look at your computer monitor and tell which direction that daily chart is going, don't trade the pair. The trend isn't strong enough. If I get into those mental debates with myself on a chart, you know, well, I think it's going up, but then if I look at it this way, I think it's going down, but then again, if I look at it, move on. Why make it harder? So with this, I mean, this chart is clearly in a downtrend, so you can just eyeball it until it's in a downtrend. But in some situations, you might want to just see, well, there's that last candle on the left, there's the last candle on the right, connect it with a line. You can draw a line on your chart. I've been known to grab an envelope on my desk, you know, and just put it up on the monitor. Which way is it sloping? You know, there's all just different kinds of ways you can do it. But that's the second checkpoint. So it's below the 200 period moving average and pulling away. We connect the last candle on the left, last candle on the right, downtrend, no question about it. Next is the pair on the daily chart making higher highs and higher lows, or is it making lower highs and lower lows? So in this situation here, we can see here's a high. Here's the next high, and this high is lower than that high. This high is lower than that one, this high is lower than that one, and so forth. So it's making lower highs, and it's also making lower lows. It just, picture a currency pair on this chart, kind of just like a staircase, stair-stepping to the downside or stair-stepping to the upside. And after you do this for a while, I mean, they're just going to jump out at you. Now, I use this USD Swissy chart a lot because it's just the quintessential example. It's the perfect example of a downtrend. I mean, you just can't miss it. So this is why, to me, it's just very great to use this example to show the higher highs and the higher lows. Lower highs and lower lows, excuse me, which again is our third checkpoint that shows definitely this pair is in a downtrend. Okay, here's a chart, New Zealand US dollar. Here's where we've got all three deals on one chart. 200 period moving average, okay, price actions above it and pulling away, check. Next thing is left to right, check. Our line's going up, higher highs, higher lows, check. Okay, uptrend, daily chart. We know from this we only want to buy this particular currency pair because that's going to be the higher probability trade. Here's a chart. I see that. I'm on to the next chart. That's an easy decision to make. This is the South African rand versus the Japanese yen. Okay, you know, how does this fit with what we've been talking about? Well, 200 period moving average. Well, it's below, it's above, it's below, it's above. It's you know, I'm getting a headache just looking at it, going up and down. If I draw a line from the left to the right, very modest slope to the downside, I'm not even going to try to figure out higher highs and higher lows or lower highs and lower lows on that. So zip off to the next chart. Why try to puzzle that out to trade it? To me, it makes no sense. Now, this is the kind of chart that, you know, I want to know more about this pair. Okay, so this is the pound Swiss, and it fits all the parameters. We've got, it's below the 200 period moving average and pulling away, lower highs, lower lows, connect left to right, bingo. You know, and I'm still not going to stop looking at other pairs once I see this. This I, you know, write down on my legal pad or 3x5 card or something like this, pound Swiss, and then I'll go through the other pairs knowing that this is one of the 1 or 2 or 3 pairs that I want to get more deeply involved with to find out what's going on with it, to trade it. Aussie USD. Here's another example. Above the 200 period moving average and pulling away. Last candle on the left, last candle on the right, uptrend, and making higher highs and higher lows. Now, this is not as clean a chart as that one is. That's a smoother trend. If I could only trade either one of those two pairs, it's going to be this one. Even though this is a nice uptrend, it's not that. Again, I'm looking for the smoothest moves possible. Okay, here's another one, Euro Swiss. The only blemish on this chart, and it's not that bad, is right there, where it wicked above. And I'm not going to throw this one, you know, out of the ballpark just because of that. But it's not as clean as the pound Swiss. Here's the pound New Zealand. Below the 200 period moving average, pulling away. Lower highs, lower lows. Last candle on the left, last candle on the right. It's in a downtrend, no question about it. But this is a mighty big enchilada hanging right out, you know, there. And that would cause me a little bit of concern, but it's been moving down, but not as smoothly as that pound Swiss. Of all these, that pound Swiss is still my favorite to trade. Determining the strongest trend to trade. This is, you know, this is not a picture of me in my youth, you know, or anything like that working out, in case you were wondering about that. But anyway, strongest trend to trade. And, you know, once you determine a strong trend, it gives you, I think, more confidence to stick with the trade. And we're going to talk about that a little bit too. Okay, here's the one, no trend at all. Goodbye. Pound New Zealand, we've talked a bit about that. Euro Swiss, we've talked a bit about that. And the Aussie USD. What I like about the Aussie USD pair is right here, we'll get into this a little more later, is here's the highest that pair ever traded. And then we get into kind of a retracement, little bit oscillation in there. And now, you see, it took out the previous high. So that, to me, is a very bullish signal right there. And that would be an entry. Once a pair takes out its previous high in an uptrend, that's a buy. That's a big buy signal. And here's our pound Swiss that we liked a lot. But even better than the pound Swiss is the USD Swissy. These are both charmers. These are both darlings to trade. But if somebody put a gun to my head and said, choose one, it's going to be that one. It's smoother. And when you see that type of a movement, that it's been continuing and continuing and continuing. And if I could put that full chart on there, I couldn't shrink it down enough to get it on there, you'd see that, like I mentioned before, the last time this pair traded above that 200 period moving average, this is October, it'd be back in July someplace, you know, off the charts here literally, that it was up above the 200 period moving average. So this is a very compelling downtrend to trade. So of the 5 that we looked at, I threw out the South African Rand chart because that was just flat as a pancake. And these are the way I would rank these for, you know, for trading. Of the 4, this would be my first choice, dollar Swiss. I just want you to get a visual of what a good, solid trend looks like on a daily chart in your mind. If you see something like that, I mean, that's great. This is very good. Okay, benefits of trading with the trend. We're trading in the direction that the market has been taking the pair. And the market is stronger than you or I. And if any of you listen to my webinars, you've heard me probably say the expression that, you know, the market is going to do what the market's going to do, and the market is always right. So when the market is taking a pair in a certain direction, I don't want to go against that trend. I mean, my gosh, my pockets are not as deep as central banks, multi-billion-dollar hedge funds and things like that. There's no way I can compete with that. So I've got to go along with the crowd. And I don't mind that, because going along with the crowd, trading in the direction of the trend, is putting higher probability trades before me. So clearly, different type of chart, but we're only buying, you know, if we see something like that. We have the courage to stick with our trades knowing that the market is behind them. In webinars, a lot of questions come up. We get emailed questions into us, and people say, you know, I can't figure out what I'm doing wrong here. I'll be up 20, 25 pips in a trade, and I'll close it out, and I'll go, all right, I made 20, 25 pips. This is great. And then go to bed, get up the next morning, pair moved 150 pips beyond that. And I go, what am I doing wrong? Chances are, you know, you don't have the confidence to stay in the trade longer. So you're taking that 25 pips and run. And there's nothing wrong with a 25 pip trade, making 25 pips. And, you know, one of my other sayings is any day with a plus sign in front of it's a good day. Plus 1 pip, I beat the market. You know, I mean, that's a good day. So you want to keep that in mind, but if you know by looking at the longer term trend, the daily trend, that the market is behind the direction you're trading the pair, that's going to give you the courage of your conviction, a little more courage to, okay, I'm up 25 pips, look at that longer term chart, that trend is still strong to the downside, hang in there. And using good money management, which is another subject, but as long as you're not risking more than 5% of your trading account, if it does, let's say you're up 25 pips and you get stopped out and you lose 100 pips, you're only missing 5% of your trading account. That's too bad, but it's only 5%. It's kind of like if I have $100 in $5 bills and I lose one of those $5 bills, I wish I didn't lose it, but I mean, am I going to lose sleep over that? I've still got essentially the buying power of my $100 there. I've got 95 now. It's not the end of the world. But a trader who over leverages and all of a sudden, you know, let's say I've got my $100 in $5 bills and all of a sudden I lose, you know, I'm down to $30. I've lost $70 in $5 bills. Okay, now I've lost a fair amount of buying power out of that $100. And so always make sure you're using good money management, never putting more than 5% of your account at risk. Our entries can be less precise as the trend can oftentimes compensate for it. Our entries can be less precise as the trend can oftentimes compensate for it. This is why, again, you like to trade in the direction of the trend. And I was trying to figure out, okay, what kind of an example can I come up with here to explain less precise entries? Okay, I don't know if any of you guys, when you were like 10 years old, were as goofy as I was, but I would love to go to the store, department stores or the mall, with my mom when she went shopping. Not to go shopping with her, but, ta-da, the escalators. Okay, you know, more store managers take me back to my, is this your child? You know, ma'am, can you kind of, you know, keep, okay, these escalators. Everybody, you're supposed to ride in the direction that it's going. It's easy. If I'm going in the direction that the elevator or the escalator is going, I look down, I check when I'm going on it, I take one step and I'm on it, and I can still be carrying on a conversation with you. It's easy. going up the down escalator. Now there's the challenge. And that's what would be fun. I mean, you got to look down. You got to decide how far you're going to put your foot forward onto that first step so it doesn't back you up and you catch your heel. You got to figure out where you're putting your left foot, and then how high up and how fast do I have to put my foot on the next escalator, and then next step, and then you got to pick up speed to make any headway. That's a precise entry. And it's tougher to do that going against the trend of the escalator. And that's what I mean about a precise entry is much more difficult going against the escalator than just, okay, there's the escalator, and hi, how you doing, and carry on your conversation. So that's another forgiving aspect of trading with the trend. Lastly, moves in the direction of the trend tend to be of a longer duration, offering more pip potential than trades that are against the trend. So, I mean, you look at all these reasons, and this is me again, and it's my opinion, but why take trades against the trend when you can do this? It's just infinitely easier. I mean, it's not a guarantee of success by any stretch of the imagination, but it's another one of those edges that you can get in your trades that can assist you to getting into higher probability trades. Once the trend has been identified, look for a technical reason to enter the trade in that direction. Now, a technical reason can be a break of support in a downtrend or a break of resistance in an uptrend. We're going to look at this on charts. Or we time our entry through the use of an indicator showing that momentum has shifted in the direction of the trend. For example, that's that Aussie USD daily chart we talked about before. And right there, that was the previous high. And we just follow that resistance line across, and we can see this candle took that resistance line out, and there were more buyers than sellers. That's what moved this pair up, obviously. I mean, it's as simple as that. Some people say, well, you know, and they think I'm being glib, but it's the truth. You know, why did the Aussie USD go up today? Well, there were more buyers than sellers. I mean, that's what makes it move one way or the other. So more buyers than sellers right there, it took out the previous high. Nothing says buying opportunity in an uptrend like price action taking out an old high. There were enough buyers here that it pushed it up beyond that previous high. So this would be an example in an uptrend of a technical reason to enter the trade in the direction of the trend. In a downtrend, here's our pound Swissy pair, and we can see it made its lowest low. I'm going to go over to this chart for a minute. It made its lowest low right there with that wick. And then it bounced off. And the charts will, or currency pairs will do this oftentimes. They'll hit a support level and then they'll bounce back up again. And as long as you don't have your stop like right on top of the wick, you'll still be in the trade. But I digress. So here's the lowest low right there, retraced a bit. And what I'd be waiting for here is I'm not going to enter this trade short until price action breaks through that support line. Because nothing says selling opportunity in a downtrend like when the previous low is taken out. I don't know if you've heard the expression buy on dips in an uptrend, sell on rallies in a downtrend. This would be where you use the indicator to time your entry into the direction of the trend. So here's our dollar Swissy chart again on the daily. And in a market, in a trading market, you're going to see that price action goes down for a while, and then you got traders in their short positions that they want to take profit. So the only way to close out a short position is what? With a long position. Yeah. You got to buy it back. Yeah. So all the traders who are profitable down through here, some of them are going to say, not all of them, some are going to say, okay, I've made what I want to make, and they enter their opposite position to get out of their short trade and lock in that profit. So as they get out of their trade, as they get out of their short, they're entering buying positions. That's what's pushing the pair up. So we get a rally up at each one of these green arrows. And the idea here is, after a rally up, I sell back in the direction of the trend. Because in effect, I'm getting in the trade at a better price. Because I've got more room for pip potential for the pair to drop. Now, the question obviously is then, how do I know when that momentum shift occurs? That's when the indicators come into play. Here's an example of buying on dips in an uptrend. So we've got a dip to the downside, that's a buying opportunity. Dip, buy, et cetera, et cetera, et cetera. Now, timing that entry. Oops, heavy thumb. Okay, here's our, make sure I'm on the right one, yep. Here's our dollar Swiss daily chart in a downtrend. And here's that rally to the upside. Okay, how do I know when that rally subsides? Well, I don't know for sure, and even using slow stochastics in this case, it's not automatic, but it's going to help me time my entry when slow stochastics crosses over 80, and the two moving averages of slow stochastics that were over 80 come down below 80, thusly, that would be my signal to enter the trade short with a stop just above, right there at that point. Same thing here, stop up above. Same thing there, stop up above. Same thing here. So every trade that somebody would have made, this is the example of a beautiful downtrend, every trade that somebody would have made at these points, and granted, hindsight's 20/20, that would have been a good trade. Another example you can use, because I'm very big on driving points home through, analogies, as you might be able to tell. Another one is like with a bow and arrow situation. Okay, if I got a bow and arrow and I want to hit that wall with the arrow and I go like this, maybe, I don't know, or it could just go like that and that's the end of it. But if I do one of these, I've got a much better shot at hitting that wall. And that's the same thing here. This is pulling the bow string all the way back. This is pulling the bowstring part way back. And this is the same thing in an uptrend, and instead of a slow stochastics, I'm using a MACD. Pick the oscillator of your choice that you like. MACD is fine. And in this situation, for those of you that might not be familiar with MACD, the red line is the MACD line. And the blue line, I think that's blue, is called the signal line. And it just tells us momentum, same as slow stochastics, but just it's a different indicator. What I tell people to do is there's probably 6 or 8 major indicators that are out there. Try them all, one at a time, on your charts. Find out which one that you like the best. Think of it as buying a car. Unless you're one of these folks that, I always buy this brand of car, well, chances are you're going out and you're test driving cars before you buy them. And the car that you like the best may not be the car that I like the best. So is your car better than mine? Well, I like mine better than yours. You like yours better than mine. So who's right? Well, we're each right. And it should be the same thing with the indicator. Use the indicator that makes sense, to you and that you understand, because they're all showing you the same thing, just through a different lens. Another thing to consider when trading is consider the fundamentals of currencies for trend trading. So far right now we've just been looking at charts, technicals. And we've determined, for example, that the Swiss franc was strong and the US dollar was weak, looking at that chart of the dollar-Swiss pair. So chart-wise, technically speaking, we know that the dollar is weak and the Swiss franc is strong. Okay, now fundamentally, anytime you're going to I like Daily FX. That's one of our websites, www.dailyfx.com. I view that site every day because it gives me insight on what central banks are doing, on momentum in the market, fundamental type of momentum, news announcements that are coming out. So another trading edge is by looking at Daily FX, by just watching, if you're watching financial news channels, if you're looking at Bloomberg, or you're watching, CNBC or whatever it might be, financial news, if those sources are telling you the dollar's weak and the Swiss franc is strong, that's more confirmation. You got technical confirmation and you got fundamental confirmation that the dollar's weak, Swiss franc is strong. So not only do you see it on charts, you also know it's true fundamentally. So more corroboration for shorting that particular pair, then that can give you the courage or your conviction again to stick with the trades longer. So a trader can use the same trend concepts on a lower time frame chart, because I know I use a lot of daily charts and some traders say, yeah, but I'm a shorter term trader. The principles of chart reading are going to be the same whether you're looking at a daily chart, a 4-hour, a 1-hour, a 30-minute, a 15-minute, a 5-minute, a 1-minute. The candles are all the same. If you see a doji candlestick on a 1-minute chart, it means the same thing if you see a doji candlestick on a daily chart. So once you understand chart reading, you can apply it to any time frame. And a trader can buy dips in an uptrend and sell rallies in a downtrend on a 4-hour chart, a 1-hour chart, a 15-minute chart, what have you. The rules are the same regardless of the time frame. But you want to keep in mind, hang on one second, I'll stay here for a minute. You want to keep in mind that every time you go down to a lower time frame, the information that you're receiving is slightly compromised because it's based on a lesser amount of data. So just remember that. If you're entering a trade off of a 15-minute chart, it's not going to be as reliable an entry. It's more likely to be a false entry than if you enter that trade on a 1-hour chart. If you enter the trade on a 1-hour chart, it's going to have a greater potential for giving you a false entry signal than will a 4-hour chart, because there's more data in each of those candles. So summary, 3 keys to determining the trend. Use a daily chart. What is price action above or below the 200 period moving average, first checkpoint? What direction does price action slope from left to right on the chart? Is price making higher highs and higher lows, or is it making lower highs and lower lows? Oops, sorry about that. And then reasons for trading in the direction of the trend. We're trading in the direction that the market has been taking the pair. And this, it's a big issue because, again, so many traders, they want to trade the pair in the direction that they think it should go. You know, well, with all due respect, who are you? Who am I? I mean, we're nothing compared to a $4 trillion a day market. Come on. We're nothing. We're not even that, you know, in the market. Well, I think it should be going the other way, so I'm gonna short the pair. Well, okay, good luck, and you know, keep plugging money into your account because it's going to keep going down. You know, in my opinion, if you keep trading against the trend, if you keep trying to call a top or call a bottom, it's a tough way to go, and ultimately it's going to eat away at your account size. We have more courage to stick with our trades knowing the market is behind them. Entries can be less precise, remember the escalator, and compensate for that less accurate entry. And moves in the direction of the trend can be of a longer duration, offering more pip potential, and that's why we're all here, and then trades against that trend. Okay, thank you for attending Trend Trading. Thank you very much.